Quarterly theory is foundation for understanding real market cycles. When you combine it with Divergence Model, you unlock a method to spot high probability entries with precision. In this video, I will break down the key principle of quarterly theory and show you how to use them to strengthen your trading strategy. Let's get started. Okay, what is a quarterly theory? Quarterly theory suggests that financial markets show recurring patterns that align with quarterly periods. Traders learn these cycles in order to anticipate how the market might behave and to prepare their strategies. This approach is based on cycles. Each quarter can be divided into 4 phases. These phases help traders understand the typical way price develops within a quarterly period, and they provide a framework for analyzing and predicting market movements. There are 2 main models, AMDX and XAMD. Let's first take a look at the AMDX model. AMDX stands for accumulation, manipulation, distribution, and continuation, or reversal. First quarter is accumulation. This is a period of consolidation where positions are gradually built. Second quarter is manipulation. In this phase, we often see false moves, sometimes called judo swing, liquidity grab, or total soup. Third quarter, distribution. Here positions are unloaded, which often leads to significant price movements. And the fourth quarter is a continuation or reversal. In this final stage, the market either continue in the same direction as before or make a reversal. Let's look at this example. Each box here represents a quarter. In the first quarter, we can see price moving slowly, which looks more like a consolidation phase. In the second quarter, the market took liquidity. In other words, we had manipulation, and then the structure was broken. In the third quarter, we can clearly see a distribution, followed by price continuing to move upward. After that, there was a small pullback. And finally, in the fourth quarter, the phase can either be continuation or reversal. In our case, there was a small pullback, but then the market continued its upward movement. Now let's move on the second model, which is XAMD. XAMD stands for continuation or reversal, accumulation, manipulation, and distribution. This model starts with continuation or reversal. In this phase, either continues the previous trend or reverse it. Second quarter is accumulation, a period of consolidation where positions are accumulated. Third quarter, manipulation. In this quarter, a stage with false moves. We can notice how the price sweeps liquidity of the last quarter or other liquidity. And fourth quarter, distribution. This phase where positions are unloaded, which is often triggering significant market moves. Let's look at this example. Here we can see that the model starts with continuation of the bearish order flow. Then, in the second quarter, price entered a short period of consolidation, mostly staying in range. In the third quarter, we observed manipulation. Price grabbed liquidity by taking out the high of second quarter, and then it reversed, breaking structure which has signaled continuation of a downtrend. In the fourth quarter, during distribution, the market made a pullback, and afterwards it reversed and continued to move lower. So essentially, this model is very similar to AMDX. The main difference is that instead of starting with accumulation, XAMD begins with trend movement, either continuation or reversal, before going into the other phases. Okay, we have covered the different trading models. Now let's talk about quarters. There are 6 main types of quarters: yearly, monthly, weekly, daily, 90-minute and 30-minute. Let's start with larger ones. First, yearly quarters. These are the standard 4 quarters of the year. First quarter runs from January to March, second quarter goes from April to June, third covers July to September, and fourth is from October to December. Next is the monthly quarter. Here, each month is divided into 4 parts based on the weeks. So the first week is the first monthly quarter, the second week in the second quarter, and so on. Then we have the weekly quarter. The trading week is divided into 4 core days, Monday through Thursday. Friday typically plays a separate distinct role. And let's move on the most crucial quarters for active traders, the ones we use for intraday trading. If you trade intraday, you need to pay attention to daily quarter and the 90-minute cycle. The daily quarter is divided by the trading session. The first quarter is the Asian session, the second quarter is the London session, the third quarter is New York AM, and fourth quarter is New York PM. And here is the key part: each of these daily session itself divided into 4 90-minute quarters. You can see this whole structure on the screen right now. The most important takeaway is this: the most volatility in the active cycle is almost always the third 90-minute quarter within any session. That's why for intraday trading, it's often best to focus on specific window. For example, you can try to trade third 90-minute quarter of each session. It can be London, or if you trade New York session, you can try the third quarter New York AM session. And to help you visualize these quarters without drawing them manually, I will show you two useful indicators. The first indicator is called Day Quarterly Theory. You can see it below the price chart. It displays colored boxes where each color represents a different cycle. The top row of boxes show the 90-minute cycles. The bottom row shows the larger daily cycles. In the settings, you can enable labels to appear on each box. The second indicator is called 90-minute cycles. This one drops the cycle directly on the main price chart. It places clear markers for the start and end of each 90-minute period throughout the trading day. You can fully customize the appearance of these markers in the settings to match your trading style. Personally, it's the most comfortable for me. Now that we have covered quarterly cycles, let's move on other details that can help us improve our interpoint. One of the most popular tools, sequential SMT. Sequential SMT divergence happens when two correlated assets move differently in terms of their market structure. For example, imagine one asset creates a higher high, but the other asset at the same time creates only a lower high. This difference tells us that momentum or strength behind the move is not equally supported across markets. Why is it important? Because when we study sequentials over time, such as quarter by quarter from quarter 1 to quarter 4, we can spot very early signals of what's happening behind the trend. It can show us execution in the move, hidden weakness, or even the possibility of a reversal. Now let's look at this example. We can notice how on the first asset the price makes a new swing high during second quarter, but on another asset, instead of higher high, it only forms a lower high. This creates a sequential SMT between second and third quarter, and right after that signal, the market reversed. But it's very important to remember, once you detect a sequential SMT, you should always wait for confirmation, either through a change in state of delivery or market structure shift. That confirmation increases the signal and gives you a stronger interpoint. Okay, after looking at regular sequential SMT, we can also see hidden sequential SMT. Hidden sequential SMT happens when correlated assets don't make new swing high or swing low, but instead show a difference in the candle bodies at the open or close, even though it's less obvious, and this can be the first sign of potential reversal. Let's look at this example. The price doesn't make a new high on both assets, but if we look at the candle bodies, we can see that on the first asset, the price didn't update the open of this candle, while on the other asset, this open level was updated. And after this difference, the market reversed. And there is a couple of additional signals that can give you a strong confirmation. First, it's a precision swing point. The precision swing point occurs when two correlated assets close opposite swings. Look at this example. NQ make a bearish swing low, while ES make a bullish swing low. When the signals align with SMT divergence, the PSP becomes much stronger, giving us a more precise interpoint. And second strong signal, precision candle point. It happens when two correlated assets close opposite candles. It doesn't need to occur at the swing and can appear anywhere on the chart. This makes precision candle a flexible tool to spot potential reversals. Let's look on this example. On NQ we can see a bearish candle, while at the same time on ES the candle is bullish. If this happens together with SMT, it can become a potential strong reversal signal. Let's break down an example to make it clear how to use this. First, you can use the SMT divergence indicator. It automatically finds divergences including precision swing point and precision candle point. How to use it? If you're analyzing an asset like the Nasdaq, you need to write its correlated assets into the indicator settings. For example, if I'm analyzing the Nasdaq, I will put an S&P to identify divergences. The same logic applies to the precision swing candle logical settings. Let's break down the specific example. You can see that on the Nasdaq, the price doesn't update the low, but on S&P, at the same time, it updates the low. At this moment, a precision swing point is forming. This means that on the NQ, a bullish swing low is forming, but on the S&P, a bearish swing low. This can tell us about potential upward reversal. And let's watch what's happened. After this, the price typically continues with an upward movement. Okay, Let's talk about precision gap. A precision gap happens when a fair volume gap forms on one asset but doesn't appear on another correlated asset. For example, the Nasdaq may create a clean imbalance during an impulse move, while the S&P shows no imbalance. Later, when price returns to fill this imbalance, the balance is often restored to the chart. Once the gap is filled, price can continue in the original direction of the move, because the market has efficiently mitigated the imbalance. And the last important thing is macros. The macro window is high volatility time that happens around the top of each hour, usually spanning from 15 minutes before and 15 minutes after. If you are an intraday trader working inside a session of using 90-minute cycles, it's very important to pay attention to macros. There are two main types of macros. The first is continuation macro, when order flow continues through the macro window, often creating strong moves. And the second is reversal macro, when a structure break occurs inside the macro, which can often be much stronger than another time. To make this clear, let's look at an example using the New York session macro. The New York session macro starts at 10:45. Let's see what happened during this period. You can notice how an external market structure shift formed, indicating a strong potential move. The second macro begins 30 minutes later. The first macro ended at 11:15, and the next one started at 11:45. And during this second macro, you can see the price forming a continuation macro. So the first macro gave us a reversal, signaled by the external market structure shift, and the second macro provided the continuation. Logically thinking about interpoints, we can interpret from the imbalance. A risk-reward ratio can be 1.5 or even 2. It always depends on situation. It's also crucial to combine the macro analysis with other concepts. For instance, if we analyze what happened between the quarters, we can see a sequential SMT. Silver updated its low in the second quarter, but gold didn't update its low in the same period. This created sequential SMT signal. Then, during third quarter, right in the middle of the macro, we get confirmation from the market structure shift pattern, and the price reverses as expected. So, we have broken down all the essential elements. The most important question, how do we combine it in trading? I can show you a few methods that I consider to be the simplest and most effective. But I want to be honest, from the start, I cannot give you one specific rigid way to trade. You will achieve the best results by practicing these concepts and building your own strategy based on your experience. Personally, I don't always rely on spotting specific patterns like AMDX or XAMD, as they can sometimes form unclearly. My primary focus is usually on sequential SSMT divergence and the third quarter. For example, if you are trading the London session, the 90-minute third quarter is from 3 AM to 4:30 AM. For the New York session, it's from 10 AM to 11:30 AM in New York time. I will say it right away that not always the third quarter it can be the most volatility. There are moments when it can be in consolidation. And this is normal market behavior. Let me show you how I typically trade this. The first scenario, trading with a high time frame interest zone. In this case, a significant zone like a 4-hour on 1-hour order block or imbalance is already present on the chart. My plan is to look for a trade if during the active third quarter the price approaches this interest zone and shows a sequential SMT between 90-minute cycles. If we get market structure break confirmation inside the macro, it creates a strong signal to consider a position. Essentially, the price arrives at the zone, and the macro movement provides the final confirmation. It's important to note that we don't always enter during the macro. Sometimes focusing solely on the macro might cause us to miss the initial move. I pay close attention to the macro because of the high volatility, but confirmation also can happen before macro. Second scenario, trading with session-based daily sequential SSMT divergences. This scenario might not require a predefined high time frame zone. The core idea here is to spot a daily divergence, specifically during the 90-minute third quarter. This often manifests as a sequential SSMT divergence based on session highs and lows. Let's break down an example where during the third 90-minute cycle, we see this daily sequential SSMT divergence form, and then we open position based on strong confirmation signal from the macro. Let's analyze a couple of examples on the chart to make it more understandable. First example. This example from the current London session. On the hourly time frame, we can identify an imbalance, and the price is inside this zone of interest. Since the main trading period is about to begin, I will mark it from 3 AM to 4:30 AM. Then, on lower time frame, we can spot a hidden divergence. If you look at the GBP/USD, we can see that the price has breached this opening level, while on Euro USD it didn't. Now, switching to the 1 minute time frame, we can observe an SMT divergence. Let's also mark the macro as it's already underway. We need to wait for confirmation from a market structure shift signal. Once the price broke through this level, we could enter a trade. There is an imbalance above us. In principle, you can place a limit order from the imbalance level or enter with a market order. I will open a market order, the stop loss will be placed above the recent swing high, and the take profit will target the nearest liquidity pool. So, okay, the price has successfully reached our target zone. Let's review this trade step by step. First, high time frame context. The price was approaching a key interest area on the high time frame. Second, divergence signal. Inside this zone, a hidden divergence was visible. Subsequently, an SMT divergence formed on the lower time frame. And third, macro confirmation. During the macro window, we got confirmation from a market structure shift signal. Okay, and second example. In this example, we can observe a divergence between the NQ and S&P. The NQ didn't update the Asian session low, while the S&P has clearly broken this low. This price action is significant as it indicates the potential formation of daily sequential SMT. To refine our entry, we move to a lower time frame and mark macro window. And we need to wait for the formation of a market structure shift. Okay, following the macro, a clear market structure shift formed. This provided the confirmation to enter a long position. And the trade reached its profit target. That's everything on quarterly theory. Take what you have learned, put into practice, and keep improving your trading. Trust the process, and I will see you in the next video.